like US Bank, let you add to your deposit later to increase limits. Capital One sometimes offers deposit graduation, matching additional deposits dollar for dollar after 6 months of on-time payments. The application process is straightforward. Unlike unsecured cards, approvals are nearly guaranteed because you're putting down collateral. You'll need a bank account to fund the deposit. Some accept money orders, your social security number, and proof of address. Most secured cards don't require a credit check. They're designed for rebuilding. Your small limit card serves one purpose: reporting positive payment history. Don't use it for everyday spending yet. Charge one small item monthly, let it post to your statement, then pay in full. This shows activity without risking high utilization. One viewer puts his $1.99 Apple iCloud charge on his $25 limit card. Perfect for building credit with zero risk. Fraud protection on secured cards is identical to premium cards. If someone steals your card number, you're not liable for unauthorized charges. This is a key advantage over debit cards, where thieves can drain your bank account. Always use your secured card for purchases, never ATMs, as cash advances hurt your score. Adding an authorized user can amplify your efforts. Once your secured card is 6 months old, consider adding a trusted family member. Their responsible use helps you both, and some issuers report authorized users to bureaus just like primary accounts. Verify reporting policies first. Credit mix matters too. Pairing a secured card with a credit builder loan creates a diversified profile faster. The card handles revolving credit, while the loan covers installment credit. Together, they satisfy 100% of credit mix requirements. We'll cover loans next, but know this combo is the express lane to good credit. Interest rates on secured cards are high, often 25% or more. But that's irrelevant because you should never carry a balance. Set up autopay for the full statement balance monthly. The only cost should be your initial deposit, which you get back, and possibly a small annual fee for premium cards. Store-specific secured cards rarely help. For example, Target's Red Card only reports to TransUnion, and the Walmart Capital One card is difficult to graduate. Stick with network-branded secured cards, Visa, MasterCard, Discover, that report comprehensively. Store cards can come later once you've established primary trade lines. When you close the account or graduate to unsecured, deposit recovery is simple. Issuers mail checks or make direct deposits. Capital One often processes refunds in 5 business days, while Discover mails checks within 2 billing cycles. Keep your address updated to avoid lost checks. Some credit unions offer better terms. Navy Federal's secured card requires $50 plus deposits, but offers rewards and lower rates. Alliant Credit Union's secured Visa gives 1.5% cash back, rare for secured products. Local credit unions sometimes have special programs for first-time borrowers. Always compare options. Avoid depositing more than necessary. A $200 secured card reports the same positive payment history as a $2,000 one. Only deposit what you can afford. The scoring model doesn't consider dollar amounts, only percentages and patterns. Digital tools can help manage tiny limits. Apps like Cred.ai create virtual cards with adjustable limits to prevent declines. Privacy.com offers similar controls for online purchases. These tools ensure your $25 card remains useful while building your score. If your budget allows, consider opening 2 secured cards simultaneously. Perhaps $25 on Capital One and $50 on Discover. This creates multiple trade lines faster, but requires careful utilization management. Never apply for more than 2 cards within 6 months when rebuilding. The psychological benefit is real. Seeing paid as agreed on your credit report after collections or charge-offs helps rebuild financial confidence. Secured cards prove you can manage credit responsibly, which lenders notice when reviewing manual applications later. Parents can help teens start early. Adding a minor as an authorized user on your secured card establishes their credit file legally. Some issuers permit this at age 16. By graduation, they could have a 700+ score before their first real job. Credit line increases happen automatically with good behavior. Discover often doubles limits after 7 months, while Capital One increases limits incrementally based on usage patterns. Always accept these. They lower your overall utilization ratio across all cards. Now that you've got secured cards working for you, Let's add another piece to the puzzle: credit builder loans that actually pay you back while boosting your score. These are the only loans where perfect payments mean you walk away with more money than you started. Credit builder loans that make sense. Here's your credit builder loan section. A credit builder loan might sound counterintuitive. Why pay interest just to build credit? But when done right, these loans can boost your score and even leave you with extra savings. Here's how it works. Instead of receiving the loan money up front, the lender holds it in a secured account. You make monthly payments, which are reported to credit bureaus. Once the loan term ends, you get the money back, minus a small amount of interest. Let's break it down with an example. Say you take out a $1,000 loan through Self Financial for 24 months. Instead of receiving the $1,000, it's deposited into a locked CD account. You make fixed payments of about $48 per month, totaling $1,152 over 2 years. At the end, you get the $1,000 back, and your net cost is $152, or about $6.33 per month, to build credit. Meanwhile, your credit report shows an installment loan with perfect payment history, which strengthens your score. Self Financial is one of the most popular options. You can choose loan amounts between $500 and $5,000, with terms ranging from 12 to 24 months. The CD account even earns a small amount of interest while you make payments. Credit Strong offers a similar setup but allows longer terms, up to 60 months, which can help build credit age. They also offer flexible payment plans, starting as low as $15 per month. While their interest rates are slightly higher, the extended terms may benefit those looking to establish a longer credit history. Local credit unions often provide better deals. Many offer share-secured loans, where you use your savings account as collateral. For example, Navy Federal Credit Union offers loans starting at $250 with no credit check and interest rates as low as 2 to 5%. In some cases, the dividends earned on your savings can offset the loan's interest, making it an even more cost-effective option. Always check with credit unions you qualify for before turning to national services. It's important to avoid shady operators. Some companies advertise credit builder loans that are really just overpriced credit monitoring services. A legitimate credit builder loan will appear on your credit report as an installment account. Be wary of upfront fees over $100 or companies that don't clearly explain their reporting policies. Flexibility in payment schedules is another key factor. Self allows bi-weekly or monthly payments, while Chime's Credit Builder program links payments to your paycheck deposits. Bright Money adjusts payments based on your cash flow. The best programs adapt to your income schedule, making it easier to stay on track. Reporting frequency also matters. Most reputable providers report payments to all 3 credit bureaus monthly. However, some smaller credit unions only report quarterly, which can slow your progress. Always confirm reporting details before committing. One viewer shared how she wasted 6 months with a local bank that only reported to Equifax, barely moving her overall score. Early termination penalties can be a hidden pitfall. Some lenders charge hefty fees for paying off loans early or closing accounts. Look for programs like Self that allow cancellations after 3 months without penalties. Just keep in mind that shorter loan terms provide less credit history impact. For those with damaged credit, cosigner options can help. Some credit unions allow cosigners on share-secured loans, making it easier to qualify. After a year of perfect payments, many lenders will remove the cosigner requirement, giving you full control of the account. Here's a quick success story. One user, Sarah, had a credit score stuck in the low 500s after years of missed payments. She started with a $500 credit builder loan through her local credit union, making on-time payments for 12 months. By the end of the year, her score jumped over 100 points, and she was able to qualify for a car loan with a much lower interest rate. Stories like Sarah's show how these loans can be a stepping stone to better financial opportunities. If you're looking to maximize results, consider combining a credit builder loan with a secured credit card. This creates both installment and revolving credit history, which satisfies 100% of the credit mix requirements in FICO scoring models. Just make sure to manage both responsibly to avoid overextending yourself. Finally, remember that payment size doesn't necessarily impact scoring. A $500 loan with perfect payments helps just as much as a $5,000 loan. Only borrow what you can comfortably repay. The goal is to build credit, not to impress the algorithm. Credit builder loans are a powerful tool when used wisely. They're not just about improving your score, they're about creating opportunities. Whether you're rebuilding after financial setbacks or starting from scratch, these loans can help you take control of your credit journey. The magic credit utilization number. Here's your section on credit utilization. You've probably heard you should keep credit card balances below 30% of your limit. That advice is outdated, and it's actually costing you points. The real sweet spot? Using less than 10% of your available credit, ideally between 1 to 9%. Why does this matter? Utilization accounts for 30% of your FICO score, nearly as much as payment history. Think of your credit utilization like managing your game character's energy levels. If you're constantly running at 30% or higher, you're not optimizing your performance. But keeping it in the 1 to 9% range? That's like staying in the green zone. Your character is at peak efficiency, and so is your credit score. Here's how it works. Credit card companies report your balance once per month, usually your statement balance. It doesn't matter if you pay it off in full later. Whatever balance shows on that statement gets reported to the credit bureaus. This means you could pay your bill in full every month and still show high utilization if your statement cuts with a high balance. Let's break it down with an example. Say you have a $1,000 limit card. Instead of sticking to the old 30% rule, $300 balance, aim for under $90, 9%. Even better, keep it at $10 to $20, 1 to 2%. One viewer tested this. At 30% utilization, her score was 712. At 9%, it jumped to 738. At 1%, it hit 753. That's a 41-point difference just by managing when balances report. To take full control of your utilization, use the ASIO method, all 0 except 1. This strategy ensures perfect utilization across all cards while maintaining some reported activity. Here's how to do it. Step 1 *, note each card statement closing date. Call customer service if unsure. Step 2 *, pay all cards down to $0 a few days before their closing dates. Step 3 *, let one card report a small balance, ideally $5 to $20 on a $500 plus limit card. Step 4 *, pay that remaining balance immediately, after the statement generates. Why does this work? The scoring model rewards responsible credit use, not avoidance. Zero utilization across all cards can actually hurt slightly compared to showing minimal usage. Keep in mind, credit card companies don't all report on the same schedule. For example, Chase typically reports statement balances. Discover often reports on the last day of the month. Capital One tends to report balances around your monthly due date. Tracking each card individually is key. A simple spreadsheet works fine. List each card with its reporting date and usual balance. Small balance reporting solves several problems. 1. It prevents high utilization across your profile. 2. It maintains active credit history. Some issuers may close accounts with prolonged inactivity. 3. It shows you're using credit responsibly without overspending. One cardholder with 15 accounts uses this system religiously, letting a $1.99 Netflix charge appear on one card each month while keeping the others at $0. His score? 811. Calculating ideal amounts is simple. Take 1% of your credit limit, then subtract $1. For a $300 limit card, that's $2. For a $5,000 limit, $49 shows less than 1%. These tiny balances still register as active usage while maximizing your score. One exception. If you have subprime cards with very low limits, e.g., $200 or less, letting $0 report may be better than showing even 1% utilization, since such small limits don't help utilization ratios much. Timing your payments is critical. Most issuers take 1 to 3 days to process payments, so pay at least 3 business days before your statement date to ensure the payment posts in time. Don't wait until the due date. That's often weeks after the balance already reported. Some institutions even let you change your statement date, which can help consolidate reporting across cards. A few other things to keep in mind. Closed cards *, even if you close an account, its limit remains in your overall utilization calculation for FICO scoring, though not Vantage score. Closing old cards with high limits can spike your utilization percentage. So always calculate your total credit limits versus total balances before closing accounts. Business cards *. Most business credit cards don't report to personal credit bureaus unless you default. Even if they do, their limits typically aren't included in personal utilization calculations. Store cards *. Retail cards often have tiny limits, $300 to $500, that are easy to max out accidentally. A $150 balance on a $300 limit store card means 50% utilization, enough to drag down your whole profile. Either avoid using store cards entirely or pay them down before the statement date every month. Authorized user accounts *. When you're added as an authorized user, that card's balance and limit factor into your overall utilization ratio. Before accepting authorized user status, verify the primary user keeps utilization low on that card. The magic number to remember is 8.9%. FICO's scoring model doesn't differentiate between 1% and 9% utilization in terms of points earned, but crossing above 9% causes a noticeable score drop. Aim to keep reported balances safely under that threshold for maximum benefit. Need a quick score boost? If you're applying for a mortgage or loan soon, pay cards down early for the 2 months prior to show near zero utilization. This can add 20 to 50 points quickly. Just remember, utilization has no memory. Once balances report higher again, your score will adjust accordingly. The bottom line? That 30% rule is better than maxing out cards, but far from optimal. For serious credit building, 1 to 9% utilization is the real target. Using the ASIO method and tracking your card's reporting dates puts you in full control of this major scoring factor.